You passed the challenge, you followed the rules, you hit your profit target, and then they gave you the funded account. And within 2 weeks, it was gone. Not because you stopped trying, not because you got unlucky, because nobody told you that the game changes the moment real money is on the line. Here's what the prop firm industry doesn't put in its marketing material. 90% of traders who attempt a prop firm challenge never receive a funded account. And of the 10% who do, a significant portion fail that funded account within the first month. The same traders who proved they could follow the rules, who passed the evaluation, who did everything right, they blow the funded account faster than they blew personal accounts they'd been trading for years. You're not imagining it. You're not a bad trader. You were handed a map with no legend. In this video, we're going to expose 3 mechanical traps built into the prop firm structure that nobody explains before you pay the challenge fee. We're going to show you why the daily drawdown limit is a psychological elimination mechanism disguised as risk management. Why your stop losses, placed exactly where your education told you to put them, are sitting in the highest probability zone to be triggered before your trade can work, and why passing the challenge might actually make the funded account harder to survive, not easier. The first thing they never told you is how the rule that looks like it's protecting you is actually the rule most likely to end you. Let's start with the rule every prop firm calls a risk management tool, the daily drawdown limit. It sounds reasonable, it sounds professional, 5% maximum loss per day. After that, you stop trading. You protect the capital, you come back tomorrow. That's the pitch. Here's the reality. The daily drawdown limit doesn't punish reckless trading. It punishes the most natural human response to losing, the attempt to recover. And that distinction is everything. Every experienced trader knows this pattern. You take a loss in the morning, it's not catastrophic. You're down 2%. You still have room. And that room is the problem, because now you're not trading your strategy. You're trading to get back to flat. Your position size creeps up. Your selectivity drops. You need to make back what you lost before the day ends. And by 2 in the afternoon, you've hit the daily limit, not because you're a reckless trader, but because you responded to a loss exactly the way every human being is wired to respond to a loss. This is not a discipline failure, it's a structural trap. Here's what makes it mechanical rather than random. The daily drawdown limit resets at midnight, completely independent of your overall monthly performance. You can be profitable for the month, you can be up 8% over 3 weeks, and a single afternoon session where you try to recover a 2% loss can end the account, permanently, regardless of everything that came before it. Documented prop firm rules confirm this. Across the industry, FTMO, Topstep, MyFundedFX. The daily loss limit is a hard stop. There is no appeal. There is no context. The month doesn't matter. The trade doesn't matter. One session, one breach, and the evaluation is over. And here's what the marketing materials never say directly. The traders who fail the daily limit aren't failing because they lost. They're failing because they tried to stop losing. The rule specifically punishes recovery attempts made under emotional pressure, which is exactly when recovery attempts are most likely to be made. This is not a theory. This is observable in the prop trading community. The documented failure pattern, a profitable month ended by one emotional afternoon, is the single most commonly discussed experience across prop trading forums. You weren't failing the challenge. You were being eliminated by the mechanics of how the challenge responds to human psychology. But even if you master your emotions and protect the daily limit, there's still a second trap sitting inside your technical analysis, waiting for you every single time you place a trade. Every trading education course teaches the same stop-loss placement rule. Put your stop below support, above resistance, outside the structure. Give the trade room to breathe, but protect yourself from catastrophic loss. It's the first risk management lesson in almost every course, every book, every mentor program. And it's placing your stop exactly where the market is most likely to go before it moves in your direction. This is not speculation. This is documented in actual order flow data. In 2003, researcher Carol Osler published a study in the Journal of Finance using real bank order data from the foreign exchange market. What she found was this: stop-loss orders cluster at predictable levels, round numbers, recent highs and lows, technically visible support and resistance zones, the places where every trader following standard education places their stops. Her data showed that when price approaches these levels, the clustered orders execute sequentially, each triggered stop accelerating price further through the level, creating a cascade that takes price well beyond the initial technical zone before momentum exhausts itself. What does that look like on your chart? One candle. A candle that spikes through your support level, takes your stop, and immediately, sometimes within minutes, sometimes within the same candle, reverses back in the direction of your original trade. You called it bad luck. The data calls it mechanical. Here's why it matters for prop firm traders specifically. You're trading a smaller account with tighter drawdown tolerances. You cannot afford to be stopped out and then watch the trade work without you. That pattern, stopped out, trade works anyway, isn't just financially damaging. It's the setup for the next emotional session. It's how the daily drawdown trap gets loaded. Research on institutional fund managers found that professional participants use the same technical tools differently from retail traders. Institutions use support and resistance to time entries within broader positions, not as standalone entry and exit signals. The stop levels that retail traders place at correct technical locations are being placed at the same levels that order flow research has documented as the highest probability trigger zones in the market. You were taught where to put your stops by the same education that never told you those levels are documented in academic literature as predictable stop execution zones. But the stop-loss trap and the daily drawdown trap are both manageable if you understand them in isolation. The third mechanic is what makes them lethal together, because it activates specifically when you think you've already survived the hard part. You passed the challenge. You did it. 8 weeks of disciplined trading. You hit the profit target. You stayed inside the drawdown limits. You controlled your position sizing. You proved you could follow the rules. And then the funded account arrived. And something changed. Not the market, not your strategy, you. This is the third mechanic, and it's the most invisible because it doesn't look like a trap from the outside. It looks like success. Passing the challenge feels like the finish line. It's actually the starting gun for a different psychological environment, one that the challenge structure never prepared you for. Here's what prop trading communities consistently document. The traders who pass challenges often do so by trading more conservatively than they naturally would. Smaller position sizes, higher selectivity on setups, fewer trades per session. The rule structure creates disciplined trading as a temporary adaptation, not as a permanent change in behavior. The challenge works. You adapt, you pass. Then 3 things happen simultaneously on the funded account that the challenge environment never produced. First, a real payout is now possible, which changes how you think about every trade. Not smaller, bigger. You want to make it count? Second, withdrawal requirements and scaling rules add complexity to decisions that felt clear during the challenge. Third, the psychological pressure that the challenge's rule structure temporarily compressed returns in force. FTMO has acknowledged in their own published materials that the funded account presents a distinct psychological challenge from the evaluation. The structure that helped you pass is not the structure you're now trading inside. The daily limit is the same number on paper. The experience of approaching it when a real payout is on the line is not the same experience, and so traders who spent weeks demonstrating they could manage a challenge account revert, often within days, to patterns that look more like their accounts before they ever paid a challenge fee. The same position size creep after a profitable session. The same emotional recovery attempts after a loss. The same exact sequence now playing out on a funded account that took weeks and hundreds of dollars to earn. Research on day trader persistence by Barber, Lee, Liu, and Odian, tracking hundreds of thousands of traders over 15 years, found that traders continued trading despite clear evidence of structural failure. The persistence itself became the mechanism of the loss. That's the funded account failure pattern in a single sentence, not inability. Persistence inside the wrong structure. You didn't blow the funded account because you couldn't trade. You blew it because the challenge taught you to adapt to rules, not to understand the mechanics underneath them. And now you know the difference. So what does the trader who understands all of this actually do differently? Not more and less. More deliberately. Here's the framework. After any single losing trade, not a losing session, a single trade, impose your own daily stop before the prop firm's limit becomes relevant. Set your personal maximum daily loss at half the firm's limit. If their ceiling is 5%, you stop at 2.5%. This is the buffer that prevents the emotional recovery pattern from loading the elimination rule. The firm never told you to do this because it isn't in their rules. It's in the mechanic. Before every trade, look at your stop location and ask one question. Is this where everyone else's stop is? If your stop is below a round number, below the last obvious low, directly under a visible support zone, you're in the cluster. Move it to a less predictable location or reduce your position size so that a stop hunt through that level doesn't generate enough damage to feed the next trap. And trade your funded account the way you traded the last 5 days of your challenge, not the first 5. Your most controlled behavior, not your most confident. The funded account is not a reward for passing, and it's a second evaluation with higher psychological stakes. Remember that stop that got taken out right before the market reversed in your direction? Now you know why. It wasn't bad luck. It was your stop sitting in a documented, academically verified cluster zone, executed exactly the way clustered stop-loss orders execute. You're not a bad trader. You were given an incomplete map. Now you have the mechanic. Stop trading the challenge. Start trading the structure you're actually inside. Tell me in the comments, which of these 3 traps ended your last funded account?